Hi, I'm Rod Cross from Regional Finance Solutions. Welcome to the second in our series of videos on buying property in your self-managed super. Today I'm going to talk about borrowing to buy a property in super. Funds have been allowed to do this since 2007, but it's really important to understand that getting a loan inside super is not like getting a mortgage on your home. There is a host of ATO regulations and bank hurdles you are going to need to jump through, so it's a good idea to be prepared. Here are the key things you should know. The law requires that you secure what's known as a limited recourse borrowing arrangement. There are three important things you need to know about this type of loan agreement. First off, the loan can only be secured against the one property being purchased. You cannot use the equity you have in other assets or properties in the super fund to support the loan. Secondly, when buying a residential property, the transaction needs to be completely at arm's length. You cannot buy from, sell to, or lease to a family member, friend, or colleague. These requirements are more relaxed though with regards to commercial property. Thirdly, and this one's important, the borrowed funds cannot be used to improve the property, so you can't buy vacant land or a rundown property and then use borrowed funds to build or renovate. A limited recourse borrowing arrangement means that your lender will not be able to come after any other assets in your super fund in the event of default. This is good for your super fund, but it does add risk for lenders. Because of this, and the amount of government regulation around lending to a super fund, lenders tend to be more cautious. Expect to pay a much higher deposit than you have on your home or other investment properties, most likely 20% on residential property and 25 to 35% on your commercial property. On top of that, many banks may require what's called a liquidity premium, which basically forces you to hold a percentage of the property value in cash within your self-managed super fund. Since other assets in your fund can't be used as collateral for the loan, it's a safe bet to think that banks will ask for a personal guarantee from every adult member of your fund. In the event of a default, this guarantee does potentially open your assets outside of super to a claim from the lender. You can expect a lot of due diligence from the banks. They'll look at the financial position of the fund itself, its history of contributions, plus the financial position of the beneficiaries of the fund. If you're buying a property to lease back to your business, they'll also want to have a look at the financial position of your business. Borrowing inside a super is a complex area. It really pays to use a mortgage broker with experience in this type of lending. They'll be able to shop around on your behalf and make sure that you meet all of the lender's criteria. Surround yourself with a team of professionals who understand superannuation and real estate before diving into buying property in your super fund. The right team will help you make wise decisions and manage the whole process effectively.